Welcome to ET Now Market Summit 2026. As millions of new investors enter the markets, India's investment landscape is evolving rapidly. What will shape the journey of the next 100 million investors? We now turn to our panel discussion, The Next 100 Million Investors.
Good evening, everyone, and good evening to our very esteemed panel as well. We're having this conversation to try and plug the gap between what takes a person from being a saver to an investor. And Harsh, it's going to be an interesting conversation at that.
Very interesting. In fact, the next 100 million investors are obviously not sitting in this room, but they're going to influence markets, right? So we'll try and get a sense as to how they will, and what better panel than this to kind of give us that spread as to what this is going to lead to. We have A. Bala, of course, needs no introduction, Managing Director and CEO of Aditya Birla Sun Life AMC. We have Nilesh D. Naik. He's head mutual funds at PhonePe Wealth. Thank you. And we have Sundeep Sikka, ED and CEO, Nippon India Mutual Fund. Wonderful having all three of you. Let me first start off by asking you, how quickly can India get its next 10 crore or 100 million investors? Let's go around quickly, and if we can take a guess as to how quickly can we get there.
I think first I want to congratulate ET now for the 17th anniversary. And I'll answer that question by saying, I think 17 years back, the mutual fund industry size was less than 7 lakh crores. And today we are 80 lakh crores. And I can't make a guess, but I think before the next 17th anniversary, which is before 34th anniversary of yours, I think you'll see every Indian household will be a mutual fund investor, which means technically we would have crossed that number by then.
Wow. Okay. Nilesh.
So, if you look at the last, let's say, 5-6 years, right, just talking about numbers, December 2019, we had roughly about 10 million unique investors in, let's say, mutual fund industry, right? Today, we are more than 60 million. So within a period of, say, 5 to 6 years, you have added those incremental 50 million customers. Now, to get to that 10 million, first 10 million, if you remember, the mutual fund industry, the first private player, I think, entered the industry way back in 1993. So it almost took quarter of a century to add the first crore. But within 5 to 6 years, you have added 5 crores, which means what you added in 25 years, you are adding almost every year, right? So I think even at that rate, forget about the compounding part, even at that rate, I would say 10 to 12 years, you will have additional, maybe 100 million investors.
Sounds conservative, Nilesh. Bala?
So I think we are always conservative in estimate. So I think what you just mentioned that, so all of us have spent, me and Sundeep have spent more than 3 decades in the Indian mutual fund industry. As he rightly put it, Nilesh put it, first 10 years we have to do all the hard work, and go and sell mutual fund is something that would make investment. And then growth would have been very, very small and very slow. The next 5 years would have been much faster, next 10 years would have been much faster. But the last 10 years, if you take from 2019 till date, you would have seen one of the fastest growing industry. And if you look at, link that with if you put a graph in terms of awareness versus the growth, there's a simple graph you put, there's no such graph that exists. But today the awareness about investing in mutual fund is actually far higher than we would have probably had about 3 years back. Therefore, what Sundeep mentioned about Har Ghar, there has been SIP, this will probably become much easier in the next, say, a decade. Therefore, the 10 million customers that we are talking about, the unique customers, will come faster than what you have seen in the last 4 or 5 years.
Right. Balas, let me ask you the next question. Where do you see the biggest cohort of investors coming in the next 5 to 10 years?
I think if you look at the general customer cohorts, if you look at it, there used to be a significant dominance coming from cities like Mumbai. The top 10 cities used to contribute almost about 90% of the AUM, and the rest of the market used to contribute only about 10%. When you say India, when you say Bharat, you cannot say this is representing only about top 10 cities. As we move forward, we'll probably see more and more participation coming from the deeper parts of the location. They are the ones who have not tested the mutual fund as much as it should have done.
That makes sense. Nilesh, let me come to you. You're now starting to get used to seeing investor journeys scale, right? It's not just about payments anymore. It's about getting penetration. What are the key barriers? Because barriers have changed. They've shifted. Now you do payments through a click of a button, investments through a click of a button. What's the key barrier that's stopping us from getting the next 10 crore investors?
No, I think firstly it's already happening, but relatively speaking, if you think about, let's say, 5 years back versus now, people are a lot more comfortable, investing into products like mutual funds. But I think if you ask me about barrier, probably making that choice, right, of where to start, which product to start, is still a bit of a challenge. The other aspect, which I think the earlier speakers have also mentioned, which is a significant progress in terms of the KYC process. But I, for one, would believe that there is still scope to simplify it further. And a lot of people, fence sitters who want to start investing, if we make that part simpler, it just helps. And I think that is one of the contributing factors in the last few years as well, with India stack, the KYC, the Aadhaar, and even the payment part, happening so smoothly. That has been a big contributor, and I think that innovation will keep continuing. Apart from the point I mentioned about helping customers to start with the let's say right product or a right set of products.
Sundeep, it seems like the markets may do well now that we've got some positive developments on the geopolitical front. SIP numbers have continued to look robust despite everything that's happening. Would you say the average investor is late to the party? Is that something you can conclude for people who've not made the most of this dip?
I think I would like to see it a little differently. I mean, I also like to touch on the earlier question. I think first, I think what's happening is till now, while the mutual fund industry has touched 80 lakh crores, the reality is only 4 to 5% of India is investing in mutual funds. So, to your question, late? No, I think we are not late. I mean, the Indians have just started investing in mutual funds. Again, a data point what Bala mentioned about, I mean, 10 years back, Delhi, Mumbai were contributing about, the top 10 cities were contributing 72%. Today, it's come to 50%. Today, more investors are coming from small cities and towns. With technology, with a lot of things happening, I think today you'll see more and more investors coming into mutual fund industry.
Even commission structures are better, B30 plus, and that helps.
I don't think so. I think it's not about commission structure anymore. I think what we have to understand is investment behavior is made over generations. Indians have been used to investing, and I think Indians confused savings and investments. Till 15
Very
years
true.
back, 10 to 15 years back, when banks were giving double-digit returns, there was no motivation for anyone to go to capital markets. But today it's a new India. I think we see more investors coming from smaller cities and towns.
Excellent. And that makes a lot of sense. Nilesh, if I can come to you, what's the single biggest mistake that the first time investor makes in his first year, in your opinion?
Yeah, I think one of the biggest mistake I think that people do is not having any plan. When in life generally, when we do even a small thing, traveling from, let's say, one place to another, you put a plan in place, right? I'm going to go by a cab or a car or public transport or whatever. But when you invest, which is such an important decision in your life, right? People don't plan, and what they do is probably look at a fund which has been recommended by someone on social media, or you just look at one return number, 1 year, 3 year, or something, and you end up investing into that product. I think that's the biggest mistake I would say, and it's not just the starting product; it also has influence on how the customer sort of is retained in the industry, his second, third investment, because the initial experience is extremely important. And at least, we at PhonePe, for example, focus a lot in ensuring that the first product that we offer or the first few products are core products which can, give customers a really good experience, which is very, very critical.
Nilesh, just following up to that, UPI, the penetration has been wonderfully high in India. The adoption has been so good. Now, when I do a UPI transaction, I get to see the result in 2 seconds. I know my transaction has gone through as soon as I scan the QR code. On the flip side, when I'm investing in an SIP or in the equity market, it could take me months or years to know what the outcome of my decision is. So, what I'm trying to say is UPI is a lot to do with instant gratification, investment is delayed gratification. How do you bridge that gap? How do you make a product for users who are very used to instant gratification, and how do you try to make them play the longer game?
So I think SIP has been a great product in terms of whatever success that we have seen, right? And by default, when you say SIP, it's a long term, right? So we have been focusing heavily on SIPs. In fact, today we are among the top 3 intermediaries in terms of the new SIPs that come in the industry. So first is that. Second is in terms of your messaging, be it investor education, be it how you put it in your journeys on the app. We talk about long term. You will always say that, okay, this product is meant for, let's say, 5-year plus. So the expectation is set upfront, and people are not expecting results immediately. And I think that is very, very important. Like you rightly said, a lot of people are used to buying, let's say, a t-shirt or a jeans on some of the e-commerce apps. But the moment you get the product, you realize whether it is good or bad, and today you can return it back, right? But in a mutual fund product or any investment product, you only get to know 3 years or 5 years later. And therefore, the first point that I mentioned, ensuring that right product is sold to the customer is extremely, extremely critical, from an overall perspective.
Bala, how do you ensure that?
See, one should understand mutual fund is a boring vehicle. It's a pure boring vehicle. You keep investing. Sometimes returns comes extremely high. Sometimes returns will be very bad. But if you take the average return that you will get more than the nominal GDP. If you invest, if you expect instantaneous gratification, the mutual fund is not the place to come. So that's the expectation. Expectation setting is actually very, very important. If you set the expectation that I'm investing for a purpose, the purpose is actually a goal. Everybody has got a goal that I need to build my portfolio for long term for the following purposes. The purpose is known, you must pursue it now without looking for any instant gratification or even long-term gratification. Long-term gratification, instantly it comes to you because you've done all the hard work. Mutual fund vehicle also does exactly the same. If you stick to your asset allocation, stick to your regular investing and stay with conviction, optimism is actually has to be permanent, built in your DNA. If you do that, mutual fund will become a boring, yet it will give you better outcome.
Nilesh, on that note, what do you believe is the one product or the one service that the industry now needs?
Yeah, I think more than the product itself, it's the way you position the product. I'll give you one example, right? We were looking at some data which is related to the working population in the country, right? And what we realize is this 6 out of 10, is a, what you say, micro entrepreneur, right? Is a self-employed individual. It could be a kirana shop or a vegetable vendor or whatever. So if 10 people are working in the country, 6 are, self-employed individuals. And in fact, with that hypothesis, partnering with, various AMCs, we launched a daily SIP product. By the way, this product was launched long time back and didn't take off in a big way. But when we did this, I think 3-4 months back, the results were phenomenal. So the reason I'm saying this is because there's a section of potential investors who were not able to invest because you didn't have that kind of feature in a product, right? So if someone has to invest 2,000, 3,000 rupees per month, for a self-employed individual, a kirana shop or a vegetable vendor, it becomes very difficult to take out those 2,000, 3,000 rupees on a single day. But if you tell him to invest 100 rupees per day or 50 rupees per day, it becomes very, very convenient. And we are surprised with the results that, with that, almost the numbers have gone like significantly higher when we talk about the new acquisition that happened.
I think that concludes this session. Thank you so much, all 3 of you.
Welcome back to ET Now Market Summit 2026. As India's wealth landscape evolves, investors are rethinking their approach to wealth creation. What should the new wealth playbook look like? Let's hear the insights on India's new wealth playbook from Karan Bhagat, founder, MD and CEO 361.
Thank you for gracing us on eating our 17th birthday. What a year it's been, right?
Thank you. Thank you for having me here. And coincidentally, it's also 17 years for 361. So it's exactly
Congratulations.
so it's exactly 17 years for both of us. We turn 18 this year, so it's been a long journey.
Wow.
But I can say that for ET and for ET now and for 361, journey's just about started.
Yeah. But Karan, not 17 years. For 17 years, as they say, investing is all about patience. The first question on my mind is, what are the kind of calls that you've got in the last 6 months from your investors? What's their mindset like?
I think overall, India has become substantially more patient in terms of volatility. I think capital is substantially more patient. One of the best things which is there in India is the leverage still continues to be quite low. So people really don't have necessarily a large panic when there's a little bit of a drawdown. The other thing which is, I think, really worked well to everybody's advantage is the diversification of asset classes has been massive. I would today conjecture that not more than 50 to 60%, and in a lot of clients' cases, 40% of the money is in direct equity or long-only equity, either through mutual funds or through stocks. Nearly 20 to 30% has found its way into credit, fixed income, yielding assets like REITs and InvITs. Another 10-15% has found its way into gold, silver, and maybe potentially 5% in the odd international feeder funds. So portfolios are very well diversified. And honestly, if you've kind of maintained this portfolio diversification over the last 2 odd years, portfolios are still broadly in the region of 10, 11, 12%. So though equities broadly have ended up at 7, 8, most of the portfolios are quite close to the 10 to 12% mark.
And how do you see the diversification of investors as well? From the point of view earlier, you have high net worth individuals coming in. Now you have family offices and other a sophisticated pool of investor coming in.
I think all three are different, right? I think if you look at retail investors, they are getting the diversification through multi-asset class funds. Okay, so I think you've got a lot of ideas, a lot of funds now which are able to take multi-asset classes. So I think the AUM of those funds have really grown over the last 12, 18, 24 months. For high net worth individuals, obviously, there are wealth managers like us who are able to work with them on a one-on-one basis to be able to diversify their AUM across multiple asset classes. And then finally, you have family offices. I think family offices are quite sophisticated. And more often than not, they've kind of broken their wealth into 2 parts. One is the safety pot, which is really kept in super safe instruments. And then after that, you largely have a growth portfolio, which is kind of engineered to grow at 12, 14, 16%. So I think that's the way the three have kind of broken up. And on the retail side, I think you'll see more and more money actually going into either solution-based products or multi-asset products as time goes by.
But is that the playbook, Karan, which is going to work in the next 1 to 2 years as well? You think multi-asset, multi-geography exposure?
So it's really tough to predict what's going to work in the next 1-2 years, but I always like to give this example, so I'm going to give it. It's a very interesting fact that just let's take 12 years for an example. I think 12 years broadly speaking, I'm going to kind of approximate a few things, but broadly speaking, the volatility of a Government of India bond and volatility of the Indian index is broadly the same over a 12-year period. Over 1 year, obviously, it's very different. The volatility of the Indian index might be 13-14%. Bond will be substantially lower. So in a sense, risk is nothing but the ability to tolerate volatility. And theoretically, if all of us could be Rip Van Winkle and go to sleep for 12 years, there would be no reason to invest in fixed income because over 12 years, you're taking the same risk. Obviously, equities is broadly giving you 2 times that of fixed income. But reality is, all of us look at our portfolio every 3 months, 6 months, sometimes weekly, sometimes daily, and you're not able to really kind of digest the volatility. So I think next 1-2 years, honestly, there are a lot of variables in the world which are unknown. So I think volatility will be very high. And to digest the volatility, I think diversification is critical. So I think, honestly, 3 years from today, 5 years from today, we'll be in a good place. But we all have to not only believe in that, but we have to also experience that. Because when the drawdowns of the portfolio are large, we end up taking decisions which are not rational.
Have you seen drawdowns in the last 12 to 18 months? The kind of, we have seen geopolitical risk coming in, tariff or whether it's a West Asia crisis, are investors worried about it? Do they want to shift from risky assets to maybe more safer haven?
I think investors broadly are quite smart. I don't see a crazy amount of panic, to be honest. I think domestic flows have been quite good. And obviously, people like us, everybody here, the entire mutual fund industry, the regulators got a superb investor awareness budget. But if I look back and say, and we are sitting in 2026, it's an epic year because the first time I really got exposed to capital markets in some senses was 97, 98, when we had a similar currency crisis, right? We had the entire Asian currency crisis in 97. And I often think about this, but assume she was Nostradamus, okay? So and she had the
I wish.
and she had the ability to predict what's all going to happen in the world in the next 30 years, and she got it all right, okay, over the next 30 years. So she predicted the Asian currency crisis, the entire tech meltdown in 2001, the entire internet bubble, 2001 WTC attacks, 2003 Parliament attacks, 2008 global financial crisis. Fast forward 2021 to COVID, where maybe potentially 300, 400,000 people lost their lives. And most of us couldn't get out of home for nearly 18 to 24 months. And yet reality is, and I missed so many things in the middle, right? September 11th, 26th September, and so on and so forth. All of that has happened over the last 25, 30 years. And in spite, the world's obviously grown, close to 7 to 8% in dollars. India's grown close to 13 to 14% in rupees. And we all are in a phenomenally accelerated geometric and exponential point compared to where we were in 96, 97. So I think drawdowns will be there. Okay. I think the point I'm trying to make is volatility is the ability to bear risk in the time being. Okay. Because eventually everything will be okay. So we have to build our portfolios in a way where each one of us is able to digest the ups and downs we will see. And that's really what our job is. We have to kind of ensure that the portfolio is diversified enough where you don't see large drawdowns.
But Karan, the debate is not about staying invested. I think that's a lesson every investor has learned. It's about the speed at which you need to juggle your portfolio that investors are grappling with right now. Be it geographies, be it quantums, be it asset classes. To that, what do you think should be the right strategy in the next 1 year? Because I know even 2 is a very long term, given the way the world is right now.
Actually, I would disagree with that a bit. I would say don't juggle it at all. Okay, so I think if you just go back again to my old example of 30 years back, I think in the order of what finally influences the outcome of a portfolio, I think 75 to 80% is asset allocation. Okay, so if you just go back 10, 15, 20, 30 years, the most important decision is how much you decided to invest in equity and how much you decided to invest in debt. I don't think so. The most important decision was which mutual fund did you buy, or did you buy the index? Yeah. So I think the fundamental thing is don't juggle your asset allocation much. And that's first thing obviously is decide your risk profile. Second, decide your asset allocation. If you're going to be 70% equities, 20% fixed income, 10% super safe debt, okay, that's 90% of the job done. The last 15%, I would say half is timing and half is instrument selection, okay? So timing is okay. You kind of obviously look at price to book, price to earnings a little bit at the point of constructing the portfolio. And the last 7-8% is really going to be about about instrument selection. So if you honestly see, if you would have chosen the index, okay, over a bunch of 6 active funds, okay, the difference between the average of the 6 funds and the index, obviously the 6 active funds have done better. They've done 100 basis points, 150 basis points, or 200 basis points better than the index. But that's only 1.5-2% over a return of 12, 13, 14%. But your decision of how much to invest in equity and how much to invest in debt is the most important decision. So for me, honestly, if every person can build a small investment policy statement where they decide their risk-taking ability, they decide their asset allocation, and finally, I'm not saying don't optimize it, and then optimize your timing and instrument selection. But we should all be aware that 85% of the battle is already won in the first 2.
Karan, Bhagat, thank you so much for your time today.
Thank you.
Pleasure speaking with you.